In 2022, a retiree holding $500,000 in bonds did everything the textbook said to do. She held steady and didn't make a single move. Then she checked her year-end statement and found she had lost $65,000. The bond market, the safe part, the conservative allocation her advisor had recommended for decades, had just delivered its worst calendar year in 270 years. 270 years. The United States was still 13 colonies. That failure exposed something most investors never confront directly. Almost nobody who owns bonds actually understands how they work. And bonds are everywhere. They sit inside your 401k, your target date fund, and every municipal budget in the country. More critically, the bond market quietly sets your mortgage rate, prices corporate borrowing, signals recessions years before most economists acknowledge them, and explains why your savings account pays you almost nothing while the government borrows at dramatically higher rates. It is a machine with roughly $145 trillion running through it. Every stock market on Earth, combined, is smaller. Today we're going to close that gap, in plain language, with actual dollar amounts attached to every concept. We'll cover what a bond is, and the single rule that governs everything in this market. How a specific number you've probably never looked up is silently setting your mortgage payment right now. Why 2022 unfolded the way it did. And where ordinary savers are losing thousands of dollars every year. In a gap, most banks are quietly counting on you never closing. If this kind of analysis is useful to you, subscribing is the best way to make sure you catch the next one. A bond is a loan. That is the entire foundation. When a government, a corporation, or a municipality needs capital, it can either go to a bank or borrow directly from investors by issuing bonds. As an investor, you hand over a fixed sum of money, called the principal. In return, the borrower makes two promises. They will pay you a fixed interest payment at regular intervals, called the coupon, and they will return your full principal on a specific end date, called the maturity. That is the complete instrument. A contract that says, lend me money today, I will pay you interest on schedule, and I will give your principal back when the clock runs out. The United States government is the largest single borrower in this market. The national debt currently sits at roughly $37 trillion, a figure that becomes abstract at that scale. A more useful way to picture it, the interest payments alone on that debt run over $1 trillion per year, which works out to roughly $3 billion every single day. The government now spends more on interest payments than it does on national defense. Every dollar of that interest flows directly out of tax revenue, and the rate attached to it is set by the same market that sets the rate on your mortgage. Everything else in this video depends on understanding one single rule. When interest rates rise, the price of existing bonds falls. When interest rates fall, the price of existing bonds rises. They move in opposite directions, every time, without exception. Here is why that has to be true. Suppose you buy a $1,000 bond paying 3% interest. That bond pays you $30 a year. A few months later, new bonds are issued at 5%, paying $50 a year on the same $1,000 investment. Now, you want to sell your bond on the secondary market. Nobody will pay $1,000 for it because they can buy a new one that pays $20 more per year for the exact same price. To make your bond competitive, you have to drop the asking price until the $30 it pays represents a 5% yield on whatever someone actually pays for it. At 5%, that price is approximately $600. Your bond still pays $30 a year. It still returns $1,000 at maturity. But right now, on paper, your $1,000 investment is worth $600. Every example of bond market damage in this video is that same rule operating at a much larger scale. Of all the instruments in that $145 trillion market, one sets the price for more American financial decisions than any other. The 10-year U.S. Treasury note, currently yielding around 4.5%, is the benchmark banks look at when deciding what rate to charge on a 30-year mortgage. The logic is direct. A bank making a 30-year lending decision first asks a simple question. Why would I lend money to a private household for 3 decades when I can lend to the federal government for 10 years at 4.5% with virtually zero default risk? The answer is it wouldn't, unless the household pays more. So the bank takes the 10-year yield and adds roughly 2 percentage points to account for the risk that the borrower might lose a job, face a health crisis, or default. 4.5% plus 2 points puts the current national average 30-year fixed mortgage rate at approximately 6.5%. The math is that mechanical. One thing worth being precise about here. Once you close on a fixed-rate mortgage, that rate is locked for the life of the loan. The bond market's leverage over you happens at the moment you apply, when your rate is set. If you bought a home in 2021 and locked in at 3%, subsequent bond market moves do not touch your payment. But if you are shopping for a home today or need to refinance, the current 10-year yield determines your cost before a single word of paperwork is signed. Consider Carter. He needs a $375,000 30-year fixed mortgage. At 6.5%, his monthly principal and interest payment is approximately $2,371. If the 10-year Treasury rises half a percentage point before he closes, his rate climbs to 7%, and his monthly payment becomes roughly $2,495. That is $124 more per month across 360 payments, meaning that single half-point move costs Carter $44,640 over the life of the loan. A full 1-point rise to 7.5% takes his monthly payment to approximately $2,622. $251 more every month. $90,360 over 30 years. To see the full range of the bond market's reach, run Carter's loan through 2 real historical reference points. In January 2021, the 30-year fixed mortgage hit an all-time low of 2.65%. At that rate, Carter's payment on the same $375,000 loan would have been approximately $1,511. At the October 2023 peak of 7.79%, that same loan would have cost roughly $2,698 per month. Same loan, same buyer, same house. The only variable was the yield on the 10-year Treasury. The spread between those 2 historical moments is $1,187 per month, or $427,320 across the full mortgage. The 2022 Federal Reserve rate cycle demonstrated all of this at a scale most investors will spend a lifetime hoping never to witness again. Coming out of the pandemic, the federal funds rate sat near zero. By the end of 2022, the Fed had pushed it above 4% in roughly 9 months, the fastest tightening pace in 4 decades. Apply the rule. Rates rise, existing bond prices fall. The broad U.S. bond market, tracked by the Bloomberg U.S. Aggregate Bond Index, lost 13% in 2022, the worst calendar year in that index's recorded history, going back to 1976. The S&P 500 fell 18.1% the same year. A traditional 60-40 portfolio of U.S. stocks and bonds, the conservative default that financial advisors had recommended for generations, lost approximately 16%. The seatbelt did not hold. It was attached to the same crash. The reason losses varied so dramatically across different bond funds comes down to one number that appears on every bond fund's fact sheet, a number most investors have never looked up. It is called duration. Duration measures how much a bond fund's price will move for every 1 percentage point change in interest rates. A fund with a duration of 6 will lose approximately 6% of its value when rates rise by 1 point. A fund with a duration of 17 will lose approximately 17% from the same move. Put those numbers against the $500,000 portfolio from our opening. A retiree holding that balance in a broad bond index fund with a duration of 6 loses $30,000 when rates climb 1 point. The same $500,000 in a long-dated Treasury fund with a duration of 17 loses $85,000 from the identical rate move. Same retiree, same balance, same rate increase, $55,000 of difference, entirely determined by one figure printed on a document most people never read. Duration is the difference between a manageable dip and a retirement-altering loss. Knowing it is not optional if you own the fund. The distinction between a bond fund and an individual bond matters enormously here. If you purchase an individual bond and hold it to maturity, the price swings along the way are irrelevant to your outcome. You collect every coupon payment. You receive your full principal back on schedule. The rule about rising rates pushing prices down is real, but for a buy and hold individual bond investor, it only creates a problem if you are forced to sell before maturity. A bond fund is structurally different. It never matures. It is a continuously repriced basket of bonds, and every rate move shows up immediately as a gain or loss on your statement. The 2022 losses we just described were not temporary accounting adjustments. They were real, and they did not reverse when the calendar turned. The bond market does not only price government borrowing, it prices every company that needs to raise capital as well. When a corporation issues bonds, investors immediately compare that offering against the yield available from U.S. Treasury bonds. Treasuries carry virtually no default risk because the U.S. government can always issue more dollars to pay back dollar-denominated debt. A corporation cannot. Companies face real business risk. They can lose revenue, take on too much leverage, or go bankrupt entirely. So investors demand a higher yield from corporate bonds than they would accept from the government. And that gap between the two is called the credit spread. Within the corporate bond universe, the riskiest segment carries the widest spread. High-yield bonds, sometimes called junk bonds, are issued by companies with weaker credit profiles, and the premium investors' demand for holding them over treasuries is called the high-yield spread. When that spread is narrow, it signals that investors are calm, credit markets are functioning normally, and the default risk on those companies feels manageable. When the high-yield spread widens sharply, the bond market is making a very specific statement. It expects rising defaults, tighter corporate cash flows, and deteriorating economic conditions. That signal typically moves before unemployment data, before GDP reports, and before most equity analysts adjust their price targets. The high-yield spread is one of the cleanest early warning indicators available to any investor willing to look at it. The same underlying logic drives what happens during periods of genuine financial fear. When investors anticipate a recession, react to a banking crisis, or absorb a major geopolitical shock, they sell corporate bonds and equities simultaneously and move capital into U.S. Treasury bonds. This is called a flight to quality. The mechanics are straightforward. Demand for treasuries surges, which pushes treasury prices up and treasury yields down. This dynamic is also the core reason the traditional 60-40 portfolio worked reliably for decades. When stocks sold off, money typically flowed into treasuries, pushing bond prices higher and cushioning the overall portfolio loss. The two assets moved in opposite directions often enough to provide genuine balance. What made 2022 so structurally different was that the source of the damage was rising interest rates, and rising rates are simultaneously bad for both equities and bonds. There was no flight to quality trade available, because the instrument people would normally flee to was itself being repriced downward by the same force causing stocks to fall. The hedge broke, not because the theory was wrong, but because the specific cause of that particular downturn happened to be the one scenario where both assets decline together. Understanding that distinction matters, because a 60-40 portfolio is not permanently broken. It behaved exactly as designed for roughly 50 years. But knowing the one condition under which it fails gives you a level of preparedness that most people holding that allocation simply do not have. Bond yields also shape how investors price every equity market on Earth through a mechanism called the equity risk premium. The logic starts with a simple comparison. Government bonds offer a known, guaranteed return. Stocks offer a higher expected return, but with real uncertainty and no guarantee attached. The gap between those two expected outcomes is the equity risk premium, the additional return an investor demands for tolerating stock volatility instead of sitting in a guaranteed government yield. Right now, if the 10-year Treasury pays 4.5% and a reasonable long-run expectation for stock market returns sits around 7%, the equity risk premium is approximately 2.5 percentage points. That is the compensation investors are accepting in exchange for taking on the risk of owning equities. When bond yields rise, that premium compresses. If the 10-year moves to 5.5%, while stock return expectations stay flat at 7%, the premium shrinks to 1.5 points. At some threshold, a growing number of investors decide the reduced reward for owning volatile stocks no longer justifies the risk when bonds are offering something meaningful and guaranteed. They sell equities and rotate into fixed income. The long equity bull market that ran roughly from 2009 through 2021 was substantially a story about near zero bond yields, making almost any expected stock return look attractive by comparison. The 2022 reversal was substantially the mirror image. Yields rose sharply, the equity risk premium collapsed, and capital rotated accordingly. Understanding that connection leads directly to the most reliable recession predictor in the public data. The yield curve is simply a chart plotting Treasury yields across every maturity, from 3 months out to 30 years. In a normal environment, short-term yields sit lower than long-term yields because locking money up for longer requires more compensation. Currently, 3-month Treasuries yield approximately 3.85%. The 2-year yields roughly 4.1%. The 10-year sits at 4.5%, and the 30-year yields close to 4.9%. That upward slope from left to right is what economists call a normal yield curve, and it reflects the straightforward reality that uncertainty compounds over longer time horizons. Occasionally, that slope inverts. Short-term yields rise above long-term yields, meaning the 2-year starts paying more than the 10-year. When that happens, the bond market is making a specific prediction. It expects the Federal Reserve to cut rates within the next 1 to 2 years, because the economy will slow enough that the Fed has no other option. According to research from the Federal Reserve Bank of San Francisco, every single one of the last 10 U.S. recessions, going back to 1955, was preceded by an inverted yield curve, 10 for 10, across 7 decades. No other publicly available economic indicator comes close to that track record. The most actionable gap in most Americans' financial picture has nothing to do with sophisticated investing. The FDIC reports the national average interest rate on a standard savings account at large banks sits at roughly 0.38%. 3-month U.S. Treasury bills, backed by the full faith and credit of the federal government, currently yield approximately 3.85%. High-yield savings accounts through online banks sit around 4.2%. All 3 options carry essentially identical safety profiles. T-bills are Treasury-backed. High-yield accounts are FDIC insured up to $250,000. The only real difference is what each one pays. Carry that gap through an actual example. Carter holds $55,000 in a standard savings account earning 0.38%. That earns him $209 over the year. The same $55,000 in 3-month T-bills at 3.85% generates roughly $2,118, more than 10 times the income on the same cash with no additional risk. Over 5 years, Leaving that money at the traditional bank instead of moving it to T-bills costs Carter approximately $9,545 in interest he simply never collected. T-bill income carries one additional structural advantage. It is exempt from state and local income taxes, which widens the effective gap further for anyone in a high-tax state. For anyone specifically concerned about inflation quietly eroding the real value of their savings, the U.S. Treasury offers a direct solution. Series of foreign savings bonds pay a composite rate that adjusts automatically with inflation every 6 months. The rate currently in effect through October 2026 sits at 4.26%. Purchase limits apply, $10,000 per person per year through Treasury Direct, so I-bonds are not designed to absorb large sums. For cash that needs to maintain purchasing power, rather than just a nominal balance, they are the most straightforward inflation hedge available to an ordinary saver without requiring a brokerage account or any particular financial expertise. Which brings the full picture back to bond funds held inside retirement accounts. If your duration figure sits above 7, your fund will move noticeably when rates shift. Anything above 15 puts that fund in territory where a single percentage point rate increase generates losses that can rival a volatile equity position. Long-dated bond funds are not automatically conservative simply because they hold government debt. In a rising rate environment, they behave more like a directional bet on falling rates than a capital preservation tool. And understanding that distinction is exactly what separates someone who owns a bond fund from someone who actually understands what they own. The 10-year U.S. Treasury yield runs through every example we have covered today, like a single thread. It sets Carter's mortgage rate before he signs a single document. It determines whether a bond fund inside his retirement account is quietly absorbing a loss he has not noticed yet. It drives the equity risk premium that shapes whether his stock holdings look attractive relative to fixed income. And when the yield curve built around it inverts, it has preceded every recession in living memory with a 10 for 10 track record. Looking up the 10-year yield takes roughly 5 seconds. Understanding what it means is the difference between watching that number and actually knowing what it is telling you. The practical checklist from everything we have covered is shorter than most people expect. Know your mortgage rate structure. A fixed rate locks your payment at closing, so the window where bond market conditions actually matter to you is before you apply, not after. If you hold bond funds inside a retirement account or a target date fund, locate the duration figure on the fund's fact sheet. Anything above 7 means that fund will move meaningfully when rates shift. Numbers above 15 put it in territory where a single rate increase can produce losses that rival a volatile equity position, regardless of what the fund's name implies about safety. If you are holding cash that will not be needed for at least 3 months, the spread between a standard savings account and T-bills or a high-yield account represents thousands of dollars in income that requires no additional risk to capture. The deeper point underneath all of this is that none of it requires a finance degree or a professional trading platform. The bond market feels inaccessible, largely because most people have absorbed the idea, somewhere along the way, that it belongs to institutions and professionals. That framing is convenient for the banks that earn their margin on your inattention. Your mortgage rate is downstream from a number published publicly every single day. Your bond fund's interest rate sensitivity is disclosed in a document anyone can pull up in 2 minutes. The gap between what your savings account pays and what the U.S. Treasury currently offers is posted on the Treasury's own website. The information has always been available. What changes when you understand the bond market is not access to something new. It is the ability to read what was already there. Stocks get the headlines. Bonds set the price of everything else. And now, you know exactly how to read them.